Welcome back to the channel, everyone. Today I want to talk about how the shorts are running desperately low on shares to short and how the AMC squeeze will soon be upon us. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Robinhood plans to launch a share lending program to borrow out investors' positions so their direct market maker, Citadel Securities, can reroute the trades off exchange and short and store. Obviously, many of the users on Robinhood, on Webull and many other trading platforms have turned off the share lending permissions, and therefore those trading platforms can't lend out the shares. Now obviously at the moment, many of these trading platforms don't reimburse you for the profits that they make when lending out the shares, and therefore obviously the users turn off those share lending permissions. But Robinhood and Citadel Securities and all of these other shorts are hoping that by offering this new share lending program where users actually get paid to lend out their shares, that Citadel will be able to borrow and locate more shorts. So I want to start by talking through this article and then explain why the shorts are desperate to try and locate additional shares to short. And then obviously explain what that means for AMC and what will happen to the AMC stock if the shorts can't locate and can't short any more shares. It says Robinhood launches a stock lending program in a revenue diversification push. It says Robinhood on Wednesday said it launched a fully paid securities lending program, which lets the online broker's users lend out shares they own through the popular app to market participants and passively collect a cut of the fees. Obviously, the excuse is that it's part of Robinhood's efforts to diversify its income away from transactional revenue, aka away from payment for order flow, which makes up nearly 3/4 of the company's revenue in the first quarter, which was down 48% from a year earlier. Now obviously Robinhood already makes money by lending out shares that its customers buy on margin, but the new fully paid program will include all shares held by its nearly 23 million users so long as they opt in and meet certain qualifications. Now at this point it genuinely wouldn't surprise me if Robinhood forced their users to mandatorily opt in so they can continue to lend out these shares. They reckon the new program will potentially bring in 1 to 2 times the revenue that Robinhood's margin securities lending program currently generates. And they even said in the article, demand to borrow shares for a fee often comes from institutional investors and other brokerages looking to settle trades or facilitate short sales. aka when these other brokerages and market makers have these fail to delivers, they obviously have to locate and borrow shares to settle the trades or facilitate those shorts. They've also said that this move is partially an effort to keep up with Coinbase and other brokers that have enabled staking of cryptocurrencies. aka it's just a way for Robinhood to generate some additional passive interest to obviously generate more revenue. This seems to be a mandatory move for Robinhood, who obviously have seen their revenues and profits decrease every quarter over the last year and have seen their stock price tumble as well. Now my feelings are that most of the Robinhood users are currently using a margin account. Cash accounts tend to only be used by those day trading stocks. If you're using a margin account and you're below the PDT threshold, you can typically only make 3 day trades in a singular week period, or sometimes only 1 day trade in a singular week period. But by trading to a cash account, you can make as many day trades as you like, as long as you wait for the cash in your account to settle after every trade. For example, if you have $1,000 in your account, you can make 5 $200 trades, but then you have to wait an extra 2 days for those trades to clear and for the cash to settle. And therefore I feel that most of the people that currently have a cash account don't really buy and hold stocks for the long term, they just day trade stocks for a few hours or for a few minutes. And therefore I don't really think this new share lending policy for cash accounts will generate Robinhood all too much additional revenue. To me it seems like a reason or an excuse for Robinhood to make share lending mandatory for all of their current clients. And obviously if you haven't already gathered by now, I would suggest that you don't use Robinhood if you are still using them and change to a different broker like Moomoo or Fidelity or many of the others. And worryingly enough, it even says here that stock lending is riskier than traditional stock investing. As Robinhood notes in a disclaimer in its blog post, there is a risk that Robinhood Securities could default on its obligations to you under the stock lending program and fail to return the securities it's borrowed. It says if Robinhood Securities defaults and is unable to return loaned securities, you will not be able to trade such securities as usual. Guys, many of you may not have a lot of confidence in the stock market at the moment. There's all of this market manipulation and market fraud that seems to be going entirely unpunished. And that's why I personally also like to invest in crypto, especially now that Bitcoin is trending upwards. I personally like to invest using BlockFi, and right now if you sign up to BlockFi using the link in the description below, you can currently get up to $250 in free Bitcoin. BlockFi, you can also invest in tons of other cryptocurrencies like Solana, ADA, Avalanche, Doge, Matic, Litecoin, and many others. And that's why more than 500,000 people and 350 institutions globally use BlockFi to manage over $10 billion in assets. BlockFi as a platform is also entirely free to use and requires no minimum balance. So guys, be sure to sign up to BlockFi using the link in the description below to get up to $250 in free Bitcoin. Now, I think this is a very worrying paragraph for two main reasons. A, it's saying that Robinhood may end up defaulting and may end up going bankrupt. Now, obviously, if Robinhood does end up going bankrupt, your money should be protected and you shouldn't actually end up losing the money that you do have invested. But obviously, more worryingly, it says that if they do default, they may fail to return the securities that they've borrowed, and you also won't be able to trade such securities as usual. Okay, they'll lend out your AMC shares, which you may not get back, and you may not even be able to sell your AMC shares when the time comes and when AMC squeezes. I think this paragraph alone is enough to move away from Robinhood if you're still using the Robinhood platform, to Moomoo or other brokers. Now, I think this is important because it shows just how desperate short sellers currently are. Short sellers are obviously running out of shares to borrow to meet those failed to delivers, to satisfy those failed to delivers, and also running out of additional shares to actually short. They're getting so desperate that they are now trying to convince Robinhood to create these new share lending programs to potentially adjust current share lending programs and make share lending mandatory, and also potentially convincing Robinhood to default so they don't have to actually return the shares. Obviously, if Robinhood do default and don't have to return those shares, it means the hedgies can continue shorting AMC and they don't have to return their shares that they borrowed from you. But I do think it's important to realise that this shows that hedgies are absolutely desperate to find any additional shares that they possibly can to continue shorting AMC. And therefore, I don't think it will be long until they've even run out of shares to borrow from Robinhood and they can't afford to short AMC any longer. And now I also wanted to talk about Peter Hann's latest LinkedIn post. He said, when Archegos went down, I realised just what a house of cards the market was sitting on. He said, while his long positions based on huge leverage through total return swaps is what brought Bill down, he was also a noted short seller early in his career. He says Credit Suisse was one of his prime brokers, and Credit Suisse in February and March of 2021 was one of the most active sellers of AMC in the dark pools. And he said, so one thing that's never been discussed is, was Bill Hwang shorting meme stocks while being long stocks like CBS and other media companies? And Peter said, importantly, this is why I think the Department of Justice started with Bill Hwang and his employees, gathering more evidence for a broader crackdown on dubious Wall Street practices, aka naked shorting. And obviously now that Bill Hwang has been arrested and now that Credit Suisse has taken on tons and tons of losses, billions of dollars in losses, the shorts are now starting to struggle. Obviously, they can't employ these same practices any longer because they're currently being investigated and now they're starting to run out of legit shares that they can actually borrow. And I also wanted to quickly touch on today's market activity. Sven Henrich tweeted saying in other news, yesterday investors chased stocks for a 3% rally on a 50 basis point rate hike by the Fed because investors were relieved that it wasn't 75 basis points. But those investors then sold those same stocks today because they realised the Fed just raised rates by 50 basis points. Obviously, the market ran yesterday because the rate hike was less than expected, which is obviously a good thing. But today, the market has realised that actually a 50 basis point hike in rates is still massive, and it's not likely to even scratch at current inflation. Obviously, inflation is ridiculously high and it will take a lot more than a 50 basis point rate hike to curb that crazy inflation. And David Rosenberg tweeted saying a CNBC poll shows that 80% of small businesses are currently seeing a recession this year right now. And he said no wonder they've shed a net 105,000 employees in the past 3 months. He said it's one of the best turning point cyclical indicators that's currently out there. This is showing that obviously a recession is likely to happen this year, and a recession is currently already happening to those smaller businesses across America. And finally, just to touch on the GameStop and Loopring NFT platform, Tendy Barron tweeted saying GameStop launched a blockchain support website using Zendesk. This website shows a new GameStop blockchain logo, and the official GameStop NFT website is also saying that you can now activate Loopring Layer 2. Therefore, GameStop are clearly working with Loopring and are just about to release their NFT trading platform featuring Loopring. This is obviously brilliant for any of you that are still currently invested in Loopring or are thinking about getting back into Loopring now that the GameStop NFT platform is about to launch. Guys, be sure to let me know down in the comments below what you think about the shorts desperately running out of shares to short. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.